Welcome to Understanding Your Financials Part 2. In Part 1, we talked about the 6 basic things you need to know. Now we talk about how to organize this information so you can easily see what's happening in your business at any given time. If you have not watched Part 1, I do recommend you go back and see it. To understand how to organize the 6 things you need to know, let us meet our two friends, the income statement and the balance sheet statement. The income statement is our first friend. The income statement answers what I earn, what I spend, and what I have left over in the business this year. Now, George Tennant paid him $15,000 in rent the first year. These are just assumptions. So his total revenue will be the $15,000. However, to keep this income, he had to have some expenses. He had to have repair expenses. He had to pay property taxes. He had to market for a period to bring in the tenants. So all this expense was required to keep producing income from his assets. And then in addition, he also had an interest expense. Interest expense, however, is not really required to keep producing income from the asset, but it's only required because he did not have enough capital to buy his property outright, so he had to take a loan. So interest expense is something paid on the debt on the asset. So it's only necessary when there is debt. George gets to keep $13,375 for his business the first year, so that's pretty good. So in other words, that interest expense is justified because without that expense, he would not have had the income. So you really have to weigh the cost-benefit analysis when it comes to interest. If the interest expense is not bringing you more income or is not helping you invest in an asset that can bring you more income, then it might not be worth your while to invest in that asset. So now let's look at 2, which is friend number 2 is our balance sheet statement. It answers what I have, what I used to get what I have, and what I've kept in the business over time. So we can see the balance sheet statement on the right. We can see cash is $13,375, which is the amount George netted. We can see the property was $100,000. Those are the only 2 assets George had. For simplification purposes, I am not taking into account depreciation. And then we can see property loan was $70,000, which was the loan he received. I did not include any principal payments just to keep it simplified. We're just making the assumption he made only interest-only payments. The interest was an income statement. Capital contributions was $30,000 and retained earnings, which is his income, was $13,375. So we can see liabilities plus equity equals $113,375. Assets must always equal liabilities plus equity. So that means assets has to finance with either debt or equity. That's the only 2 ways, which is what the balance sheet tells you is what you have, your assets, and how did you get it? Did you use capital contributions or did you use debt to get it? Or did you get it from your retained earnings? Now, I want you to take the time and look at your financials and leave any questions you want me to address in future videos below. Thank you. Like what you see? Go ahead and click the subscribe button on the very bottom of this video. I look forward to seeing you in future videos.